Renita just mentioned how President-elect Joe Biden has some big plans for the U.S. economy. He plans to give it a huge injection of money, $1.9 trillion worth. He's calling for $1,400 cash payments for most Americans, wants to extend temporary benefits for laid-off workers, and will give $350 billion to state and local governments to cover budget shortfalls that were caused by shutdowns to contain the virus. The president-elect admits that this proposal is expensive, but he says that America can't afford not to act.
The crisis of deep human suffering is in plain sight, and there's no time to waste. We have to act, and we have to act now.
Bloomberg's Kriti Gupta, who writes for our Markets blog, joins us now. Kriti, Joe Biden made the announcement last night after the market day had ended. So today was really the first chance for traders to act on the news. How would you characterize today's reaction?
Well, Scarlett, there were a lot of questions about the proposal that Joe Biden put forward. $1.9 trillion is no small amount. And then on top of that, he's saying that he wants it to be a bipartisan effort. And ordinarily, that would be good news. But right now, we're dealing with just a very short time frame. And some of those sticking points from the last time we talked about a bipartisan effort, things like state and local aid or money towards virus testing efforts, those are things that Joe Biden is trying to fold back into the bill. So when we're talking about a bipartisan effort and talking about how long stimulus negotiations will take, you could start to see delays as we see Republicans push back against those same talking points. That being said, that actually spooked some of the investors today in the session. Once again, though, that being said, you did hear Biden say that it's not just this round of stimulus that he's talking about, but several rounds. So on the good side, on the bright side, I should say, that was the good news.
Yeah, maybe we can characterize the reaction also as buy on rumors and sell on news, because now that it's been announced, people can say, oh, okay, that's pretty much what we expected. Now, how are we thinking, or how are the markets, I should say, thinking about the fact that whatever number Joe Biden throws out, however many stimulus plans he throws out, he's got a pretty narrow majority in Congress. So the final package of whatever he proposes may look very different.
Absolutely. It really could. And that's another risk that you're starting to see show up in the market. Like I said, $1.9 trillion is a huge amount. And it's pretty clear that the market really, or the underlying economy, I should say, really needs this money. It's not just about stimulus checks. It's about the money going to state governments and local governments that have really been bleeding cash, and also who need to be helping with the vaccine distribution. So once again, those are the major issues. And if you actually look at some of the economic data, you're really seeing some of the pain. Just yesterday, Scarlett, we were talking about jobless claims. It's rising once again. So the unemployment picture not improving the way that we want it to. And today, retail sales dropping, consumer sentiment dropping, just a slew of economic data that doesn't exactly enlist confidence in an economy that's largely driven by consumer spending.
Fair, but at the same time, the stock market is still holding near record highs. So all of this disappointing turn in the economic data is just priced in. Is that what people are saying?
You know, it's a great question. And one of the bigger fears right now in the market is, when will the market have a reality check? Because we've seen the market just rise and rise and rise while the economy isn't recovering at that same pace. And it's kind of understood that markets price a recovery or price in economic expectations 6 months down the road. But there are concerns, just like you mentioned, that maybe this rally is a little too hot to handle.
All right, so talk about how all of this plays out for the U.S. dollar, because you've got a weak economy as evidenced by the latest data, but you've got a ton of planned government spending, that $1.9 trillion package Joe Biden has proposed. Does the market see this combination as dollar positive or dollar negative?
That's the question of the day, and it really has everything to do with the pace of the recovery. The assumption here in both narratives, the idea that the dollar would go up or the dollar would drop, the assumption here is that eventually the economy will recover, but how will the greenback really be interpreted? Will it still be that big haven currency that people use as a wild card to kind of use and buy anything that they really want, from stocks to commodities, or will it end up being something that actually attracts global investors to the U.S. stock market when people say, well, hey, some of these battered sectors like energy, sectors like retail, they're really battered, but hey, the economy is recovering now. There's a lot of upside here. Maybe those global investors will want to hop into the stock market, and to do that, you need dollars. So there are two narratives about whether they pull away from the dollar because they don't need that haven bid anymore, or they go into it because they want to hop into the U.S. stock market.
Yeah, and so important to remember that there are so many different factors, along with the fact that the dollar's value is seen as relative to other currencies. Let's talk about banks, because the biggest of the banks reported their earnings today: JP Morgan, Citigroup, and Wells Fargo. What was the takeaway from those results?
Well, I wish there was one. It was kind of a mixed picture, which is why we're really looking forward to next week and more earnings to really get some clarity. JP Morgan, the biggest one, coming out and actually showing a 42% quarterly gain. So very huge surprise profits there. Revenue beat showing strong investment banking revenue and trading revenue. Essentially, it was a good day for JP Morgan. But the downside is that Wells Fargo and Citigroup weren't so lucky. And a lot of this has to do with simply the rates environment that we're in. These banks aren't able to lend at huge margins simply because we do have rates pegged at zero. So that means they have to make it up in some of their volume. And that's just something that Wells Fargo and Citi weren't able to do.
Yeah, it continues to be a drag for the banks. Kriti Gupta, thank you so much. Really appreciate it. Have a great weekend.
The biggest stories the moment they happen from around the globe. Subscribe to Bloomberg Quick Take now for insight in an instant.